Welcome to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and as I like to remind you each and every week that I'm also the author of a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks, and my company, Taylor Hard Money Advisors, is in partnership with Chen Lin, who publishes What is Chen Buying, What is Chen Selling. You can go to subscribe to both of those letters by going to miningstocks.com, for both Chen Lin's and my newsletter. Want to thank each of you for listening to this show, making it one of the more popular shows on the Voice America Business Channel. Also want to encourage you to continue sending along your compliments, complaints, comments, what have you, to questionsfortaylor@gmail.com. Questions, the number 4, Taylor@gmail.com. And I'd like to also invite you to follow me on Twitter. J Taylor Media is my handle there. We do want to thank our sponsors for making this show economically viable. Our sponsors for this week are Novo Resources, Copperbank Resources Corp., and Calinex Mines, Inc. I've titled today's show, How a Fiat Dollar Destroys Your Wealth. Glenn Downs, Michael Oliver, and Brooke McDonald return as guests today. Now, back in 1971, which I'm old enough to remember very clearly, back on August 15th, 1971, in fact, Richard Nixon told the nation that he was temporarily detaching the dollar from gold. Well, here we are 44 years later, and gold has still been detached from the dollar, not by the choice of markets, but by the choice of governments for sure. Nixon removed gold from the dollar in 1971 so that the U.S. could wage war and fund socialism without the American people thinking that they had to pay for either. In other words, Nixon and all presidents since him have really loved the detachment of gold from the dollar because it has meant that they can lie more effectively to the American people in exchange for their votes. They can give things away and the American people think they're not paying for them. Without gold attached to the U.S. dollar, the U.S. has, with the aid of its military, been able to create trillions upon trillions of dollars out of nothing and use those dollars not only to pay for welfare within the United States, but to enrich the military-industrial complex as it wages war and redraws the map around the world to ensure the U.S. continues to control the oil markets so that it can require the dollar to be paid that oil be paid for in dollars, thereby putting a bid under the dollar. This big lie that's told to the American people and the policies that are being implemented by our governments are now leading to massive poverty and the destruction of the middle class. And while most Americans are ignorant of these facts, the Chinese, Russians, and Indians are not unaware of the systemic theft by a deceitful dollar that has virtually no intrinsic value and would quickly sink towards zero if it were not for the military force of the U.S. That requires the dollar to be used for purchases of oil. Indeed, the Chinese, Russians, and Indians are building up their gold reserves even as Keynes indoctrinated Western economists willingly allow gold to flow from west to east, to leave the coffers of the Western world, especially the United States, and move towards China, India, and Russia. And so now there is growing competition, though, from those countries that are unwilling to accept dollars. These are nations that are looking to develop competition against the Anglo-American monetary system, the post-World War II Bretton Woods system, and its aftermath, which is anything but Bretton Woods, what we have now. As long as the con game goes on, such that the Western people believe the big lie, and as long as the dollar is backed by petroleum, the existing game can go on. But as with all lies, eventually they are recognized as the distortions that are caused by those lies cause people to recognize reality. Now, that day of reckoning, I believe, is close at hand. And what I think that means is that it's going to make some major changes in the lives of those of us living in the West. When the big lie is recognized by the masses, I believe the price of gold will rise to untold thousands of dollars when measured in U.S. dollars, because gold is eternal wealth that cannot be inflated away, but the dollar, on the other hand, has virtually no intrinsic value. So, of course, I keep an eye on the price of gold daily and weekly and longer term as well. And to help us do that today, Michael Oliver will be with me in just a couple of seconds to talk about his latest views from a structural momentum perspective that he hands out to his subscribers. And then about half past the hour, Glenn Downs, who serves as Chief of Staff for Congressman Walter Jones of North Carolina, but will be with me to discuss some very important economic and geopolitical matters having very much to do with the issues of the petrodollar and all that it may mean for gold. And in just a few minutes after our first commercial break, I will be talking to Brooke McDonald. He's the president and CEO of Cornerstone Capital, as well as his vice president of explorations, Yvonne Crepeau. He will also be joining me to help us get a sense of that company's extraordinary copper-gold discovery, a major porphyry discovery in Ecuador, and what that might mean for shareholders. But now let me turn to Michael Oliver, whose work I have really grown to appreciate. I've become very attached to it because I've found on an ongoing basis Michael's structural momentum work really helps me have a very good sense on some of the major markets that I'm most interested in which direction they're heading. So welcome, Michael. I'm glad that you could join me again today.
I'm glad to be back.
Let's talk about the stock market to start with. In your March 14th missive, you noted every market has trends within trends, near, intermediate, and long-term, and those trends are not always in agreement, but when they align is usually when the more meaningful movements unfold. Are you seeing any alignments now, Michael, that might hint at some kind of major move in the equity markets?
The major thing I'm looking for right now, first, in my opinion, the annual momentum of the S&P, which is, let's call it, the largest scale that I measure. I think it turned negative in a transitional process from October through January of this year. And therefore, I think that the long-term trend is topped. I think the only issue now is the icing on the cake, and that means the little stuff and the intermediate stuff. In other words, the swings that last 2-3 weeks and the swings that last several months. My main focus right now is on what I call monthly momentum or intermediate momentum, and frankly, we have not broken it. We teased it, got within 20 points on the S&P of numbers that would have, I think, broken it at this point in time, and they avoided it. We're caught. Really, we're not in an uptrend as such. We're really caught in a sideways clump of ink, but we have not broken enough factors, intermediate factors, to the downside for me to be able to say, okay, now intermediate is negative. I think when intermediate turns negative, it will join the long term, and you'll then see unleashing. But it's a complicated cobweb up here, and frankly, I feel sorry for both sides. If you just stand back and look at an S&P chart since, let's say, last September, it's a meat market. It is not trending. Every 3 weeks one side's a winner, and the next 3 weeks the other side's a winner, and nobody's a winner. It's just gestating up here for something, and I think that's down. But I have not hit intermediate trigger numbers. This month I need to see something like 2020 on the S&P. Our recent low is 2039. Next month it's going to jump up. So in a few weeks, if the market's loitering around, let's say, 2040, 2050, could be in trouble. I'll have to get more precise as we get to the end of the month. So that's what I'm looking at. It's the intermediate factors right now.
So you're basically standing aside right now because there's no clear trend, but your sense is that the next major trend is likely to be downward, I guess. I
think that if you're an investor, a long only, you should be lightening up aggressively. If you're oriented to going both ways, in other words, if you perceive a bear and want to be short, I think you might have a light short position on, but nothing aggressive, because this is it's a mental turmoil up here for both sides. Yeah. And there's no sense pulling all your triggers at the present time. I think there'll be optimal points on the way down, not far from here. And I think the down move that follows, if these triggers are hit on the intermediate basis, it's going to be sizable enough where it really won't matter whether you got short at 2080, 2070, 2050, 2020, whatever on the S&P. In hindsight, it really won't matter that much. So if you're bearish, don't be too bearish too quickly. Relax. Okay. Take a breath.
Okay, all right. I might listen to you on that score. I certainly have been bearish, but and chafing at the bit to make money on that side of the market. But at the same time, you can get chewed up and spit out in this meat grinder, as you call it. Well, let's talk about gold just for a second. You had some very interesting comments also on the 14th of March about gold and commodities and how they relate to each other. Would you care to talk about that, and then perhaps give us briefly give us your perspective on gold right now?
Yeah, I'm very keen on a thought. I'll throw them out there to your listeners. It's 1977. Gold bottomed in 76, basically, but the main issue was the relationship of gold as on a percentage basis or a spread basis to the Commodity Research Bureau Index, CRB Index back then. Mm-hmm. I now use the Bloomberg Commodity Index, which recently bought out the Dow Jones UBS Index, but it's a good index of commodity basket. Gold in relation to that basket of commodities turned positive performer about a year ago. Went from about 9 times the price of the Bloomberg Commodity Index to about 12 times the price of the Bloomberg. That's a decent move. That's 3 points. It's a 30% move on a spread basis. Now, during that time, gold really didn't go up much. It more or less went sideways. After all, we were in the 1180s in the summer of 2013, and we were 1140-something today, so we've hardly moved much. But the Bloomberg Commodity Index has dropped dramatically. Gold has not. Now, that spread relationship in between 76 and 77, remember, those are post-recessionary years. The world economy was not in good shape, and yet commodities produced a massive bull market between 77 and 1980. What happened was the monetary flows that the central banks had created, which were much less than they've done this time around, were diverted by investors from equities into commodities. And I think that juxtaposition could be on the cusp here right now, where commodities can, in the coming few months or weeks even, be perceived by investors as cheap, a value play, etc. And if you rattle the stock market at these levels, I think there's a lot of people who'd be ready to make an asset reallocation from equity positions to commodity-type positions.
Right.
And I think that's about to occur, and I think the first big clue of that is the spread relationship between gold and the Bloomberg Commodity Index, which has gone positive. And again, back in 77, when the commodity index turned up, gold had already turned up a year prior on a spread basis. And I think we're getting that same clue this time. Why does gold turn first or cease going down first? I think it's more monetarily sensitive.
Sure.
I think it's ready to take the baton away from equities. And I think wouldn't surprise me soon that when oil makes a final low, which probably isn't far away in terms of time anyway, that this process, oil is a laggard in this process. Now everybody's focused on deflation, but in fact commodities have been coming down for several years.
Yes,
the reason they notice it now is oil has joined in. But I think it really is a laggard and not a prime focus. But anyway, what I'm arguing for is an asset reallocation, probably in the making here.
Oh, very interesting. Well, it certainly is. It certainly is interesting. It makes sense. You know, you are first and foremost a technical analyst, but you have a great understanding from an Austrian perspective of markets and economics. But I really like what you do, Michael, in that you first let the markets do the talking, and realizing that the collective wisdom of markets is greater than even your extensive wisdom, no doubt about it. And wise market participants understand that and have a reverence for the markets, which you certainly do. So I want to thank you again for passing on those insights. Very interesting, as always. Thank you, Michael, for being with us again today.
Bye.